Welcome to Mastering MHAMBA. Today we explore Chapter 4, Job Costing, adapted from Datar and Rajan's Managerial Accounting, Making Decisions and Motivating Performance, published by Pearson Education. Job costing is a critical method for determining the cost of individualized products or services, helping leaders price, plan, and evaluate performance with accuracy. Learning objectives. In this chapter, you will learn: first is the building block concepts of costing systems. Second is the distinction between job costing and process costing systems. Third is how to evaluate and implement a job costing system. Fourth is the 7-step approach to normal costing. Fifth is how costs flow through the accounting system. Sixth is how to handle underallocated and overallocated overhead. And seventh is variations from normal costing, including departmental rates and support department allocations. Section 1. Building block concepts. Opening story: hospital construction project. Imagine a hospital planning to build a new surgical wing. The project requires custom architecture, specialized materials, and highly skilled labor. Leadership must track every cost, from steel beams to HVAC installation to electrician hours. No two rooms are identical. To bid accurately, control expenses, and stay on budget, the hospital uses one costing method: job costing. This story illustrates why organizations need precise cost systems when every job is unique. Cost object. Job costing begins with a cost object, anything for which we want to measure cost. It could be a room in a new hospital wing, a legal engagement, a consulting project, or a custom machine. Direct versus indirect costs. Direct costs can be traced economically and feasibly to the cost object. Examples include direct materials and direct labor. Indirect costs cannot be traced easily, so we allocate them using cost pools and cost allocation bases. These include utilities, supervision, and equipment depreciation. Cost pools and allocation bases. A cost pool groups indirect costs together. A cost allocation base links those indirect costs to the job, ideally using a cost driver such as machine hours or labor hours. This ensures costs are assigned in a logical, systematic manner. Let's move on to Section 2, Job Costing versus Process Costing. Job costing defined. A job costing system is used when each job or batch is unique. Construction, custom manufacturing, medical procedures, and audit engagements all rely on job costing. Each job has its own materials, labor, and overhead needs. Process costing defined. Process costing is used when units are identical or very similar. Industries like oil refining, bank check processing, and food manufacturing use process costing. Costs are averaged across many units. The continuum of costing. Most companies operate along a continuum using hybrid systems. For example, a furniture company may mass produce standard parts but customize final assembly for clients. Section 3, Job Costing, Evaluation and Implementation. Job Costing Decision Framework. Managers use job costing to bid on jobs, estimate profitability, and evaluate performance. Accurate cost information supports pricing decisions, contracting, and resource planning. Actual costing versus normal costing. Actual costing uses actual rates for both direct and indirect costs. It is rarely used because actual indirect cost rates are unknown until year-end. Normal costing uses actual direct cost rates, but budgeted indirect cost rates, so managers have timely information throughout the year. Why use annual budgeted rates? Managers compute overhead rates annually for two reasons. First is the numerator reason: indirect costs fluctuate seasonally, so annual totals smooth variability. Second is the denominator reason: activity levels vary monthly, making annual averages more stable and reliable. The 7-step approach normal costing follows a structured 7-step process. First, identify the job or cost object. Second, identify the direct costs using accurate source documents. Third, choose the cost allocation base or basis. Fourth, identify the indirect cost pools. Fifth, compute the budgeted indirect cost rate. Sixth, allocate overhead to the job using the budgeted rate multiplied by the actual quantity of the allocation base used. And seventh, compute the total job cost by summing direct materials, direct labor, and allocated overhead. These 7 steps ensure consistent and accurate costing across all jobs. Source documents, materials. Job costing relies on high-quality source documents. One of the most important is the Materials-requisition record. It documents the type and quantity of materials drawn from inventory specifically for a job. This ensures that direct materials are traced accurately and assigned correctly to the cost object. Precise documentation helps maintain cost integrity and reduces errors in job costing. Source documents. Labor. The second essential source document is the labor time record. This document captures the number of hours each worker spends on a particular job. It supports accurate assignment of direct labor costs and provides a clear audit trail. Without reliable labor time tracking, job costing cannot provide meaningful or trustworthy information for decision making. Moving on to flow of costs in Section 4 Inventoriable Cost Flow. Direct materials, direct labor, and allocated overhead flow into work in process control. As jobs are completed, costs move to finished goods control. When sold, they become cost of goods sold, an expense on the income statement. Work in process. WIP on the work in process control account accumulates all costs assigned to ongoing jobs. It includes direct materials, direct labor, and allocated overhead that have been charged to jobs but are not yet complete. Work in process represents production still in progress and shows the value of partially completed work at any point in time. Finished goods and cost of goods sold, COGS. When a job is completed, its total cost transfers from work in process to finished goods. Finished goods represents completed jobs that are ready for delivery or sale. Once the job is delivered to the customer, its cost becomes cost of goods sold. This matches the cost of the job with the revenue earned, ensuring accurate measurement of profit. Period costs. Marketing, customer service, and administrative costs are period costs. They are expensed immediately and do not flow through inventory accounts. General ledger entries. Job costing requires tracking costs through T accounts such as materials control, WIP control, finished goods control, and manufacturing overhead control. Managers follow the cost flow to monitor efficiency and accuracy. Section 5. Underallocated and overallocated overhead. Underallocated versus overallocated overhead. Underallocated overhead occurs when actual indirect costs exceed allocated amounts. Overallocated overhead occurs when allocated costs exceed actual amounts. The difference must be resolved at year end. Write-off to cost of goods sold. If the amount is small, companies close the entire underallocated or overallocated balance to cost of goods sold. This is simple and fast, used when immaterial. Proration method. The proration approach spreads the difference among work in process, finished goods, and cost of goods sold. The distribution is based on the proportion of allocated overhead in each account. Adjusted allocation rate method. This method restates all overhead entries using the actual indirect cost rate. It is the most accurate but also the most time consuming. Section 6. Variations from normal costing. Budgeted direct cost rates. Some service organizations use budgeted rates for direct costs as well as indirect costs. This is useful when actual direct costs are not known until year end, such as labor with year end bonuses. Departmental overhead rates. Organizations may refine cost systems by creating multiple cost pools. Departmental overhead rates allocate costs more accurately, using separate bases such as machine hours for machining and labor hours for assembly. Allocating support department costs. Three methods allocate support department costs. The direct method allocates costs only to operating departments. The step-down method allocates support costs sequentially, recognizing some reciprocal services. The reciprocal method fully recognizes mutual services using linear equations. Job costing with multiple cost pools. Using multiple pools improves accuracy in allocating overhead. Managers compute departmental rates and apply them to jobs based on each department's allocation base. So, job costing summary. Job costing ensures organizations measure and manage the cost of unique jobs with precision. It supports pricing, bidding, budgeting, and evaluating performance. By mastering normal costing, cost flows, overhead adjustments, and departmental rates, leaders can make informed decisions with confidence. This video is adapted from Datar and Rajan's Managerial Accounting, Making Decisions and Motivating Performance, Pearson Education. Thank you for watching this Mastering MHAMBA chapter on job costing. Be sure to like, share, and subscribe for more graduate level managerial accounting content.